Good afternoon, everyone. Welcome to the Growth Fund 4 webinar. I'm here with my colleague of 11 years, David Welk, Managing Director of Acquisitions. My name is David Scherer. I'm a co-founder and co-CEO of Origin Investments. I believe I've been here 15 years, Dave, so we have been doing this quite a long time together. Welcome back. I know you're going to do some great work on individual deals and the pipeline, which your team is responsible for, of course. The format here is we'll spend just a little bit of time talking about the existing activities of the fund. Many of you are investors in the fund already. Some of you are interested in joining the fund and learning more about it. So we'll try to provide information for everyone involved. We want it to be interactive. Please use the Q&A feature at the bottom. We're going to answer all your questions. I really probably will only speak for about 15 minutes, and Dave the same, so we should have a full 30 minutes to answer all your questions. We have a lot of attendees. I think 6 questions were sent in, so I'll try to integrate those answers into my presentation, and Dave as well. So with that, let's get started. I'm going to be very quick here because many of you have been to these webinars before. And I apologize, but there's apparently some work being done in our high-rise building here. The most important thing here is actually the footnote. And if you read the fine print, we're a top SL manager, yes, but it's actually much better than that. We're ranked number 17 out of 233, which, if anyone, I'm sure a lot of people on this call can do the math, that's more like top 3%. And then the other thing that we're really proud of is that's from all of our realized deals since 2014. So you're talking about 8 years of data across dozens and dozens of deals and multiple funds. And so that's what we're proud of, is the fact that we've protected and grown capital over a long period of time. For example, Growth Fund 4 is the 5th fund that will have development in it. Fund 2 started our development track record. Fund 3, if you're a partner on that fund, has significant development. Income Plus has significant development. QOZ1 and QOZ2 both have development. So you're talking about, at this point, billions of dollars of data, and we'll share that later about what our team's been able to produce. 3,000 individual investors. What's interesting there, a lot of those are direct relationships. Some of them are from investment advisor partners. We have 62 at this point investment advisor partner relationships, which means the investment advisory firm has approved Origin as an investment, and they invest their clients into our funds. All of our investors are taxed, and the reason I'm mentioning this is later in the presentation we'll talk about the option to either sell or to stay in the fund longer term, and why, as a tax investor, you might consider staying in the fund longer term. Everything we do at Origin is about protecting and growing capital and then minimizing taxes, because we share the same goals you do. Jumping up to the 75 million, that's my capital and my partner's capital. We've invested $75 million of our own capital into our funds alongside you, and we're tax investors too. So we want to grow our capital, protect our capital, and then minimize taxes. And so we structure every fund in order to do those things. Of course, the return metrics at the top are just indicative of the top 3% managers. So 24% average gross IRR, that's on realized deals since 2014. And that equates to a 2.1 average equity multiple. Next slide, please. So the approach at Origin, I've said this twice now, but I want to stress it. It's protect and grow. One of the things I didn't go over on the last slide is we have 0 realized losses. That's pretty extraordinary with a firm that's been open through many, many different market conditions since 2008. And so we're really proud of that, that we protect and grow capital. So how do we do that? Broadly, what we do is, in the things we feel we can control, we invest very heavily into a team and process and technology that we believe builds competitive advantages. So these would be within the team. I mentioned Dave Welk has been with us 11 years. He came over from Deutsche Bank Reef. I would tell you that he's one of the best acquisition officers in the country, but so is Tom Briney, who runs our Denver office and Western operations and came over from equity office Blackstone and around the same time, 11 years ago. When you're looking at a manager, one of the things you should look at is the returns, the historical returns, but also make sure that their team is the same team that produced those returns. When it comes to us, I can unequivocally and honestly tell you that. Everyone who built Fund 1, 2, 3, Income Plus, QZ, it's the same team. We haven't had turnover. Dave and Tom are indicative of a much broader theme. We're all still here. Look at that in any management team. And then the other thing I would say is look for strategy changes or big changes in the amount of equity they invest. So if a manager is very successful in one strategy, but they're starting another strategy, that's risky. They haven't proven that they can do this other thing. Or if a manager is typically raising and investing $200 million funds, and now they're raising a $2 billion fund, that's risky because that requires a different strategy. And so that's another thing we're very proud of is even as we've grown, we haven't delivered much larger funds to the market. You know, we're very good at what we do and the size that we do with the team that we have. The things that we can't control, the first would be interest rates. We can't control that. And so what do we do? And we've talked about this a lot, but recently we did it again. We hedge them. And we hedge them in a way that probably most of our competitors don't. So earlier this year when rates were 1.8, 1.85-ish in the 10-year note, we did a lot of swaptions and those proved to be very profitable, and those returns go directly pro rata to the loans that are hedging in the various funds that we have. About a month ago, we did it again. And the reason we did it again is we're continuing to do more developments and we need to hedge those future interest rates. Interest rates can stay the same, they can go up or they can go down, obviously, but we believe we're building to a 40% margin. And so we want to control and hedge the things that we can't control in that margin. And so we did another 700 million of swaptions, which will hedge various funds, not just Growth Fund 4, but also Income Plus, QZ. And so I would challenge you and the other managers you have, ask them about what they're doing, not just what they're talking about, right? So everyone's nervous about interest rates. That's not a strategy, that's a feeling, right? So what are you doing to hedge interest rates? We believe it's the right thing to do because we have margins we want to protect. And I mentioned protect and grow, I won't dwell on that, but that's the philosophy of Origin. And you will see that play out as an investment partner over 5 years, 10 years, 15 years. We will outperform our competition in an up market. We'll outperform them even more in a down market. And by the way, everyone on this webinar, I don't know what the future holds, but I do know that real estate, quality multifamily real estate, always winds up higher over a 10-year horizon. It never hasn't in the last 100 years. But that doesn't mean there can't be a correction at some point in year 1, year 2, year 3. And the way that you manage risk is you use low leverage, right? So we always make sure that we're not over levering any of our developments or any of our assets. You select the right sites, you pay the right price for land for the development. You manage the cost of construction. You don't make aggressive assumptions about rent growth and cap rates in your model that will make it difficult to achieve your pro formas. These are all things that we spend every day, every week, every month, every year on. And I'm not positive that individual investors, you have to pick the management team that is doing this. I'm not positive that they have the domain knowledge to go deep enough to select a deal. And that troubles me. It really does. Because there's just very few people in the world that know enough about finance and real estate and the defensibility of inputs in models to make sense of what's thrown at them. We try to do a lot on the education side. Please go to our education website, and you can really self-educate yourself on that site. But at the end of the day, you're better served to select in the private markets a good management team. They will be the difference between making 2x on your money or 1.5x or no profits at all. And in the worst case, you can actually lose money selecting the wrong management team. There's massive dispersions. Next slide, please. I mentioned our development experience before, and we're taking a look back here. So the first, we just grouped this into realized deals on the left and in progress deals on the right. Probably what jumps out first is how much we've grown in terms of our activity and development. We're one of the most active developers in the country at this point. But historically, we have 435 million of realized development revenue, if you will, and that equates to a 25.64 gross IRR. This is across 7 deals, and that equates to a 209 gross multiple. Now, if you look at in process, obviously you're thinking about it's 9 times more in process as what was realized. We've invested significantly into our investment management team, our acquisition team, and specialists in construction and development in the last 3 years. And so, now when I say in process, you have to group this both into common and preferred equity, because in development we do both. We are both common equity and preferred equity. Preferred equity, if you haven't been on any of our Income Plus Fund webinars, preferred equity sits in a preferred position in the capital structure, and it has a capped upside. So it acts more like debt than equity. You also don't have rights. You're a lender, so you don't have equity control rights, but you do have a preferred position in liquidation. It's a defensive position. We typically get 20% common equity subordination, sometimes more, sometimes 25, meaning there can be 20 to 25% losses on the deal before your position is affected. And then we usually get around 13.5, 14% returns on that position. And so the reason I'm explaining this is when you're looking at 16.17 in progress, that's common and pref, and we're just averaging it. So it winds up being about a 24% on common and about a 13.75 on pref. And so the way I would digest this slide is we're continuing to track about a 24 or 25% on common. This fund, by the way, is common only. We're not doing preferred investments, but here we're showing you our total activity, because our activity in pref actually improves our process and deal flow in common. And this fund benefits from that. And vice versa, by the way. Our activity in common leads to much more deal flow in pref. It works both ways. Next slide, please. This is a scenario analysis for Growth Fund 4. And it's also reflective of how we look at the world. I mentioned protect and grow. I mentioned our focus on the downside. The downside of this fund, in our opinion, is a 1.3 multiple and 8 IRR. That would mean that some of the assumptions here are that cap rates continue to rise, multiples on EBITDA are going down, or we call it NOI. As that happens, we enter a recession, rents are negative in their growth, meaning rents are going down, not even staying flat. These are very, very unlikely, not impossible, but if you look at a 50-year horizon in real estate, it's very seldom that rents go negative. If they stop going up, that's unusual. And then the base case assumes a 17% IRR, a 1.6 multiple, and the upside at 23 and 1.9. We're underwriting to the base case. That's what we're sharing. But the reality is the world is a series of probabilities. And if you're an investor, this is where we believe the return spectrum is on this fund. The reason, by the way, the downside is still a positive return is we're building on average to a 40% margin. And so to get to that level, we're missing our pro forma by over 50%, but you're still getting that return. And so, there's a lot of things that aren't happening that we believe would, but a lot of them are not in our control. We can't control where interest rates go. We can't control where cap rates go. We can't control where rents go. We can't control where construction costs go. So these are all things that you have to take into consideration. I will say, excuse me, all of the risks that exist in this fund and in development exist in any other investment you'll make. So you can't say, well, I'm scared the market might do this, but I'll invest in stocks and bonds. I mean, they hold all the same risks, right? If you're investing in bonds, if interest rates are going up, you're losing money. If multiples are going down, you're losing money in the stock market at a constant EBITDA. So the one thing I'll say is you need real estate in your portfolio. That's been proven in the last 5 years, 1 year, 6 months. In particular, multifamily, and that's what we focus in because it's not correlating with the stock market or the bond market. And so that's interesting. It has held its value, or in our case, it's still going up in value because we're building to a margin, even when the other asset classes are negative. And so that's a good thing. That doesn't mean that it'll always go up. It just means that it's not correlating with the rest of your portfolio. And you need assets in your portfolio that don't correlate. That's about your own portfolio construction. I think that's my last slide. Next slide, please. Yes, so I feel like I did that quickly, Dave. You have a full 15 and take us away. Thank you.
Thank you, Dave, and great to be with you all again. Please bear with me. I think I'm having some audio issues, so apologies in advance, and we'll make sure that we get this corrected for future webinars. So sorry about that. As Dave mentioned, I'll be covering our current deal pipeline along with diving into one of our newly acquired assets called Solis at the Ranch. And so just to kind of generally walk through this pipeline slide here, if you participated in prior webinars, you'll have noticed that we have moved some of these assets from the pipeline to close over the past couple of months, including deals that we had previously shown on this map here, located in Atlanta and in Colorado Springs, which will focus on that particular asset in the Springs here in a minute. But the summary here, which as Dave alluded to previously, very proud of our team's significant efforts, really not just in the past few months, but this has been a year plus in the making of building this pipeline, but now totaling nearly 4,000 units and $1 billion in total transaction volume across 14 different investments in 6 different markets. And as we've discussed both on this webinar and other funds as well, one of the benefits of investing in our funds is diversification. And by diversification, I mean not just across deals, as we're showing here, 14 different deals in the pipeline, but across geographies as well. And obviously that's well evidenced here. One thing I also want to point out in the pipeline here is that we're starting to gain scale in various metros. For example, as we've grouped these now by market, so you can see that, and we've got 3 deals going, or at least in the pipeline, more that are actually in process in Austin, Charlotte, Dallas, 2 in Jacksonville, and 2 in Phoenix. And what this does is helps us generate scale, operational efficiencies through scale in driving down operational costs, which overall helps to enhance investment performance. As I mentioned, though, the benefit of building this significant pipeline of activity, we started before we launched the fund as far back as about 15 months ago. And I want to note why that's important is because that land pricing in all of our markets largely has doubled over the past 12 months. A lot of that growth has happened in the last 9 months or so. So a lot of these land bases, even still in some of these pipeline deals, are significantly in the money. And we talked about this previously, but and Dave was alluding to before in his opening remarks that we don't know what the future holds. But even if there is some sort of correction, generally speaking, we have roughly a $15,000 to $30,000 a door edge to today's market. So picking kind of the lower midpoint of that at $20,000 a door on a 250 unit project, that translates into $5 million of edge into our development basis. So we feel good if the market doesn't correct, obviously, where our land bases are at. But if we do see a correction, that's certainly one of the first places to go would be in the market value of land pricing. And we have, a significant amount of edge that could potentially erode from the market before really values are at all impaired. Also wanted to note that a significant number of the seed assets in this fund, and including some that are in this pipeline slide here, are attractively structured where we're participating as a co-GP, sometimes known in the marketplace as a co-developer, in that we have an economic structure where we're sharing in the developer's economics. And we've talked about that in prior webinars on how we were able to negotiate that. But one of the things that our ability to be flexible and come in early into some of these opportunities and participate as a co-developer has led to the ability for us to negotiate programmatic partnerships. And again, also very proud of what we've been able to negotiate in the marketplace. We now have 3, soon to be 5 different partners throughout the Sunbelt region and Mountain region, where we have a contractual right of first refusal for their entire pipeline of deals. And if you look at this fund in particular, I think 4 of the seed assets came from these relationships, with another 3 more in the pipeline. And we've been building these relationships, through prior successful partnerships in predecessor funds. And what this does is this now benefits investors across all of our funds. So Growth Fund 4 fund investors benefit from this. We have a development allocation income plus fund, which those investors benefit. And what's been great, going to the marketplace and offering various buckets of capital to developers, a lot of them have opportunity zone investment opportunities that they bring to us too. So there's a lot of synergies and cross selling that we can do to these partners in the marketplace, which then leads to them to believe that we can meet their needs across a whole host of investment opportunities. So that's really the way we've been able to form these very valuable strategic partnerships. We'll go to the next slide and do a little bit deeper dive into our newest asset that we've acquired, Solis at the Ranch. And we highlighted this opportunity, I think, on a webinar or 2 ago, as we acquired the land for this site in the late first quarter, early second quarter of this year. So we've been spending the last several months finalizing the designs and getting to a point where, which was last week, when we closed on the vertical construction and commenced construction. So very excited to kick this one off. We, as discussed previously, keeping consistent with our value proposition of having prolific partner relationships. This is our 3rd project with Jackson Dearborn Partners, and it also happens to be their 3rd deal in Colorado Springs proper itself. So a very seasoned developer here, again, in a value partner that we have within our stable of relationships. As investors in other funds know, particularly in the Opportunity Zone Fund, this continues our significant development efforts in the Springs. And this is our 4th project underway there. And we're knocking on the door of reaching 1,000 units in this market. So back to the point on scale, we're definitely reaching operational scale and have reached operational scale when this project comes online in Colorado Springs. And excited to be out there actually in 2 weeks. We're taking the entire Origin team out to the Springs for our annual retreat, and super pumped to provide the opportunity for the entire company to see one of our most active markets in the entire country. So we'll be out kicking tires on this one as a whole in a couple of weeks. The project itself is a 374 unit, 3-story garden multifamily project. It's part of a larger concept plan, which includes some walkable retail, entertainment in the district. Located in, we'll go to the next slide and kind of talk a little bit about location here, but it's located in the suburban Colorado Springs, approximately 10 miles northeast of downtown, just about 7 miles north of the airport. One of the things we love about this micro pocket here within the Springs is we're surrounded by some of the highest demographics in the area. This is a path of growth location, but you're seeing a lot of new homes being developed here in this northeast pocket, ranging from 400,000 all the way up to 1.5 million. So what that's done is, created a lot of desirability for high-end demographics within the area, to the tune of $100,000 area median incomes within a 3-mile radius. So a lot of affordability for renters to pay our pro forma rents and continue to provide some headroom to grow those rents. Residents who are ultimately occupying the project will have some great drivability to St. Francis Hospital, located about a mile to the west. And we've got thousands of jobs within the 30-minute drive, because it's a drive down to the Springs from here. But you're also looping into some of the southeast suburban submarket jobs in the greater Denver metro. And that's one of the things we love about the Springs, is that the job prospects for folks that live here are outstanding, because you can really straddle both markets. And the Springs is and will probably always continue to be a lower cost alternative to living in Denver proper. We mentioned before about it being a 3-story project. Some of the amenities of the project will have 12 carriage house style units, which you can kind of think of similar to more like a townhome type project, which are very much in demand, especially in this location. But 21 residential buildings in total, a clubhouse. It'll be it will include all the traditional Class A amenities that you would imagine for a project located within these demographics. As you can see from the aerial here, there's adjacent land development and shared infrastructure work that's already underway. So substantial site work in and around offsite has been completed. So really help expedite our construction timeline for the project. Lastly, we've executed a GMP based on current pricing in the market. From when we closed on the land in roughly April to when we closed in the vertical construction loan last week, we had underwritten a fairly sizable contingency, given that the fluctuations in pricing in the market. I know a number of you folks have asked about where that stands within the marketplace, how quickly are costs continuing to move up. But when we closed our construction loan last week and signed our GMP, we obviously had updated everything to market pricing. We were still within our escalated budget, and we have additional escalations underwritten beyond that in the event that some of our allowances, some of that pricing continues to run. Lumber, which has certainly been the topic for the past really almost 18 months now. Happy to say that in August, we actually hit the lowest lumber number that we've had in the market since June of 2020. So lumber, even though it still continues to be an allowance in a lot of these GMPs, we're pretty well insulated, given that pricing has completely fallen off. And I believe the peak on lumber pricing was roughly in that March-ish timeframe, maybe April, when it was peaking at $1,600 1,000 board foot, and now we're in August we hit in the 400s. So I think a lot of that risk has come off the table. Again, we've been pricing kind of peak lumber in a lot of our budgets, and then enjoying the fact that they've been an allowance, and we can convert the savings when we buy it out, as the lumber's needed at the jobs. So definitely lumber pricing is going our way. Other material pricing, has gone to eat into some of that savings. But net, what we're seeing right now in the marketplace is that the rate of increase is starting to subside. Not saying that pricing is going down per se, but it's not necessarily escalating to the tune of 0.5 to 1 a month like it has been, frankly, for the past 18 months. So we're starting to see that moderate. Some of that's been generated from the deceleration of home builder activity in our markets, which is really a function of, frankly, the interest rates for folks. Housing's become more expensive, all things being equal. And so we've seen the larger publicly traded home builders starting to slow their activity, which is freeing up the demand side of things for a lot of the materials that we're purchasing, and in some cases even the labor used to construct our projects. So some good news to report on there. We'll continue to update you on what we're seeing in the market in terms of pricing as we go along. But Dave, I think that is the last part of my section to cover, and I will kick it back to you.
Thanks, Dave. We are perfectly tracking time. It's amazing. It's the best we've ever done. Okay, so I want to start out. Actually, let me cover the slide before we do Q&A. So the optional hold period, let's go back to, we're all taxed investors, and you want to create the most returns and the least taxes. And so this fund has an option for you, the investor. Options are good. You can either choose to stay in the fund longer term or get out. That's up to you. It's your choice based on your liquidity, your investment goals. I'm an investor in this fund. I will be staying in the fund because it's incredibly tax efficient to stay in the fund and not realize the gain after 4 years and pay taxes on it and have to reinvest that money. What we do in the optional period, if you look at the left, this means that the building has been built, it's been rented, it's cash flowing. We can put on long-term debt. That's why we're hedging interest rates now, is because we want to hedge the interest rate until we can put on long-term debt. That would happen in roughly month 45 to 50. And that's when you'll be making this decision about whether to stay in long-term or get out. There's a very equitable and fair mechanism to do that. So, if you want to leave or stay, you can feel very good about that process. If you choose to stay, now you have a cash flowing asset, long-term debt. The target annual distributions are 7 to 9%. The target annual appreciation, we're being very, very conservative, 1 to 2%. Historically, it's been more like 3 to 5%, but we're being conservative there. And the total return, of course, would be the dividend and the appreciation element. We say 8 to 11%. That's if you choose to stay in. If you choose to get out, you're going to have a very high IRR, but obviously less multiple because it's happened over 4 years. And the way you really make wealth, not money, not good returns, not good IRRs, the way that you make wealth in real estate is you hold it for long periods of time. You get to depreciate it, meaning it's very tax efficient. You'll get dividends, but you don't necessarily pay taxes on those dividends. And real estate, high quality real estate, especially multifamily, we have a housing shortage in the US. The demographics are amazingly good. So I don't know what next year looks like, but I do know in the next 10 years, housing is incredibly well set up to outperform because we're undersupplied and we haven't reached equilibrium. So the long-term secular outlook is quite strong. We're also a country that doesn't have, we have positive population growth. You know, most industrialized countries don't. So that's a huge advantage as well. The other thing to take consideration, and let's transition to the next slide because I want to talk a little bit about fees. Can you increase that font a little bit, because I'm sure people can't read that. I can't. Is that possible on a webinar? Nonetheless, the fees here, you know, normally when you are selecting a manager, you're having to make a decision. You want to make the best choice in terms of the value, the quality of the team, the returns, the competitive advantages, even the service. How are they going to communicate? Do they have the infrastructure to report K1s, everything? Business continuity. Is this a business that's viable for 5 years, 10 years? Because you're taking that risk. And normally when you're making that decision, on the fee side, you tend to pay more for the most valuable managers, right? And that should make sense. We're actually priced really well. I talk about this with my team all the time. We're probably underpriced, candidly. I think that being that we're a top 3% manager, we have pricing power that we're not exercising. But a 1.5% management fee on accounts below 5 million is very fair. By the way, I mentioned, and I'm going to jump back and forth a little bit here, the period, if you elect to stay in after the development period, and now it becomes a longer term investment, we lower the management fee from 1.5 to 1.25. And we lower the promote, we call it the performance fee in this slide, from 15% to 10%. And so if you choose to stay in, you'll be paying a lower promote, a lower management fee for that next period, which is fair, because when we're developing, it takes a tremendous amount of team member time and effort. And when you're operating, it still takes a lot of time, but not as much. And so we're reducing that fee. The acquisition fee of 50 basis points, that is in lieu of, or because we don't have a committed fee. So typically funds have a committed fee on capital. We don't. We're saying we're not going to charge you while we look and do pre-development and those activities. But when we capitalize a deal, you'll pay for the deal at that point. And I would tell you that it's not different, it's better. It's better for you to not have a committed fee because we take all the risk of pursuit, and you're only charged when we actually find the deals. Now, one of the things Dave talked about, and I'll just add on, this portfolio is 100% sourced. So that's the other interesting thing. If you're not a partner, you can look at our deal pipeline, what's in pre-development, what's in actual development, and understand and make judgments on, is this the portfolio that interests me long-term as an opportunity set? And that's because we've been working on this pipeline for over 18 months, in some cases 2 years. So you're benefiting from that as well. This isn't a management team looking for deals. We have the deals, and I think Dave talked about that a little bit. So those are our fee structures. I would say that we're on sort of, if fees are on a continuum of 1 to 10, we're probably a 4 out of 10 when we should probably be a 7 or 8 based on the value we deliver. So we're very confident and proud of what we bring relative to the fees that we charge. If you have any questions about that, before we get into Q&A, you can always reach me directly at david@origininvestments.com. I will either answer your question or bring in a team member that specializes in that area. We have, I believe, 43 people at Origin, all cross-functional. So whatever your question is, we can answer it. And please reach out, david@origininvestments.com. Dave, we're going to jump in now to the live questions. And Before we hit the live, I want to address one theme that was emailed repeatedly in the questions that came in prior. And that was about when is the next capital call? And it's unclear to me if these are existing investors or new investors, but of the 4 questions, probably 7 or 8 were some element of this. So I want to address it. So look, to date, I'm going to assume that we have a $200 million fund. It could be as much as 250 million, but let's assume it's 200 million. We're getting close to that in terms of capital raising. So I'll make an assumption. At a $200 million fund, we've already had 58 million of capital call. So that's roughly 30%. In October, we're going to call another 27 million. And in December, we're going to call another 25 million. And so if you're looking out October, December, a fund that's presumptive 200 million, we'll have called another 25% of that fund by the end of this year, bringing the total to 55% call by the end of this year, which is extraordinary for a development fund and reflective of what I was saying earlier. It's because we've been working on it for 2 years. And so if you're in the fund and you're a partner, feel good about the fact that we've been working a long time for us. We're large investors in this too. And if you're thinking about joining the fund, you're benefiting from years of labor that, I believe have been quite accretive to what this fund will do. So that directly answers that question. If you would like more clarification, David at origininvestments.com, I can follow up with you. Dave, I have a question that I know we were going to alternate, but this is such a great question, and I want you to answer it. This was anonymous. Because you've been at the ground level at almost all of our developments, right, for a dozen years. So what mistakes have you made on developments in the past, and how has that changed your process going forward? I'd love to hear your answer too.
Wow. Yeah. I mean, we've made certainly some mistakes. I can go super granular and talk about some of the civil related things that, maybe we didn't diligence enough on the front end. And it ranges anywhere from sewer connections to, location of drive lanes. I mean, there's in a development project, I'll say this, you kind of always feel, and the interesting thing about where we're at now is that we've changed from a build and sell model to more of a build and hold model. So what we've seen is that in the development process, you kind of feel like you're always, you never quite feel vindicated until the day you sell. Because, oftentimes all you hear about is bad news on the development side. You hear about, construction issue, labor related issues, or budget overruns, or pro forma challenges. And so there's a lot of things. I mean, this could be its own, frankly, webinar. We could talk about lessons learned from development projects. I'll say the things that we've done right over time is we've picked the right locations. We've picked locations that are in the path of growth, and we have plenty of good examples of that. And we've also made sure that we don't chase market in terms of land pricing. We're always looking for an edge. So there's going to be mistakes on the development side of things. You're going to have ADA issues that you didn't catch on the design review process. There's things that just come up, changes in the field that you don't anticipate from the local electrical inspector. I mean, there's things that so that's why we underwrite contingency. But more importantly, we pick locations that are trending in the right direction over time, that give us protection, insulation in the event that it's not a question of if we're going to be wrong on a project, it's how wrong. But we've been very right about site selection and relative value on the acquisition of our respective land sites. So I know I didn't give a direct answer because it's a great question. It's highly complicated, but those are that we've done right that help mitigate ongoing development challenges.
I'll add a little bit to that. Probably a lesson we learned early on is you don't want to use a GC in a market that isn't very established in that market with deep subcontractor relationships. And so, these are the types of things that you learn experientially. So you make a mistake once and you don't make it again. You don't, but generally what is always, the reason our returns are so high in development, it all starts with deal flow. We see so much deal flow that we're able to be discerning and underwrite deals that have conservative assumptions. We drift our cap rates higher in our models, meaning we make an assumption that the multiple on earnings is lower in the future than today. No one knows that. It might be the same, it might be higher, it might be lower. We always assume that it's going to be worse. We don't trend our rents during development. Like I said before, rents almost always do trend higher, but we don't, right? So there's lots of conservative, and now the construction pricing volatility is very high. We're building in huge contingencies for those cost uncertainties. So the reason we're able to do that is we see a lot of deals, and then we can select the ones that still produce, even when stressing deals, margins, that feel like upper teens IRRs or, a 2.0 type multiple over 5. These are the types of things we're looking at. But if you're not, we bring 3 to 4 deals to credit committee every week. We had credit committee this morning. There were only 2 deals, so that's the slower week. But that means that we probably looked at, Dave, this is your team. How many deals are on a weekly basis? So if 2 are coming credit committee, what summation of work is that? Like, how many didn't come to credit committee that you looked at, or just threw out early on, or at some point in the process?
Yeah, I'd say that, each officer probably is getting 4 to 6 deals a week. So that's times 4. So there's a lot, and that's honestly the deals that we might not even underwrite. So if you kind of compound that over a period of time, and some deals are immediate no based on location or product type or basis, but those are probably 4 to 6 deals that we're each receiving times 4 market officers per week to result in 4 deals. So yeah, it's a lot of flow.
So that, just simple math, that's 1,000 deals a year. It's 20 weeks times 50, right? So it's a volume game, and one of the things that we have improved in, back to the question itself, we've improved in our ability to figure out where to spend time, right? Because what Dave and his team has to do is figure out, well, you can't underwrite 1,000 deals and spend a week each. There's not a time in the year. So based on what you're seeing, which deals, based on location, what assumptions they require, can you throw out quickly, and which do you have to look into in detail? I think we've improved there, and that was probably, I don't want to call it a mistake, but it was an area that you can improve, and you can constantly improve, right? All right, I'm gonna move on. So one of the questions I thought is just a follow up on a question I asked, or actually addressed. So the question is, how much of the swaptions that we're purchasing are hedging growth fund 4? Or I think the question was, is it? And the answer is yes. I don't have the exact percentage. Email me at David@Origin Investments. I'll ask investment management what that exact percentage is, because I don't want to misspeak. But yes, growth fund 4 is part of that hedging strategy, as is QOZ1, QOZ2, and Income Plus. And so it's all allocated pro rata, and it's part of it. Dave, fire away, whatever you want.
Let's see. George asked a question about talking about our view of expanding to additional markets. A great question, George. And if you're new to Origin and haven't listened into some of our other webinars, we take a very methodical approach in terms of entering new markets. And it starts with fundamentals. It starts with our proprietary data science program called Multilytics, where we use machine learning to supplement our boots on the ground knowledge and relationships. So we've spent a fair bit of time, frankly, talking about this topic as recent as in the last couple of quarters about expanding into some additional Sunbelt markets. And where we've come back to is, and I touched on this earlier about the benefits of operational scale. That's where we've decided is to go kind of inch wide, mile deep in our current markets, as opposed to, if we're going to expand, we're still going to stay within the same Sunbelt framework, and we're already covering the primary markets in the Sunbelt. So what we talked about was, do we go to smaller secondary and tertiary submarkets? And that comes with a whole host of risks that we've seen, firsthand, where smaller markets can get oversupplied quickly. So that can have some real challenges to rent growth. Liquidity in times of distress aren't as strong. You don't see institutional capital flowing to kind of sub-million person MSAs as you do in the larger primary markets. So we've evaluated all these risks, and I'll sum it up by saying we decided to go deeper in the markets that we're currently in, so that we can create additional scale.
Dave, did you mention the vertical integration of development as well?
I did not.
Yeah, so that's part of Dave's, yes, we decided to go deeper in the markets we're in. But part of that was increasingly we're co-developing or just developing direct. And what that winds up doing is it increases the expected value of the deal when we do it direct, because we don't have a partner that we have to split the profits with. But we also believe, I shouldn't say split, because we get 85–90% of the profits now, but take all the profits. And that's increasingly what will happen going forward, is we'll develop direct. In order to develop direct, you need to have national operations, which we're not national, but in our regions, which are Southeast Texas and Southwest, we have local offices and people that live there in investment management and acquisitions. We also have specialists in construction and development. We're set up to do this in a way that most fund managers are not. Most fund managers are asset managers and deal pickers, and there's nothing wrong with that. We've done that for years. But increasingly, we're becoming operational in our ability to do the whole deal, which will, we believe, increase our returns even more relative to our competition. When you make that decision, you also have to make a decision to specialize in more of the markets you're in, which is what Dave is speaking to there. Again, any further questions, david@origininvestments.com. This is a little bit of a different question, Dave. What's our firm outlook? I'll answer it. Potential rent caps, which you are hearing about. I don't believe it's a risk in any of the markets we're in, is my answer. And if you think about where we invest in business-friendly states that are destination states. So this is Texas, this is Florida, this is Arizona, Colorado, Georgia, North Carolina, Tennessee. These are states that are very, very unlikely to enact legislation like that. If you're talking about rent caps, you're really talking about states like California, New York, Illinois. These are much more blue states. And I'm not making a political statement here. I'm not a Democrat or a Republican. I'm just telling you that it's much more likely to happen in those states than others. It's not something that I'm concerned about in our states.
Dave, I can take this question on replacement costs for garden style multi in the Sun Belt. It's a wide ranging answer, Aaron, depending on market, largely based on two things: land pricing and labor costs. Materials are generally similar across the board, although lumber can fluctuate across between Colorado and the Southeast. But Texas is the cheapest market for us to develop in because of land pricing. Taxes are the highest there. It makes that equation circular. So there's only so much you can pay for land. Labor is also the cheapest in Texas. So I'll give you a round number, low 200s, 200 to, kind of 210 a door. Maybe you can sneak in there for 190 in Texas, suburban Texas for a garden product, all the way out to Phoenix, which has very low taxes, which is circular in terms of what you can pay for land pricing as well. That same project there could be 260 to 280 a door. Tampa's not far behind in terms of, and the rest of the market's kind of in between. So we'll bookend it as 200 in the low end of Texas to kind of 280, 290 in Phoenix and everywhere in between.
Aaron, thank you for your question. He's asking about our minimum in the fund. I believe our minimum is 50,000. So the answer is yes. If I'm not correct about that, because some of our funds are 100 and some are 50. Dave, do you know if this is 50 or 100 off the top of your head?
I think it's 50, but I believe Aaron's question is, can I invest below 50?
Okay, got it. So I misread the question. Unfortunately, no, Aaron, our minimum in any fund is 50. And that's because we have 3,000 investors and we want to make sure that they all not only have good returns and risk adjusted returns, but a great service experience. And that's where we believe is, the minimum that we can provide what our investors want in terms of their service. So for example, if you have a question, it will be answered by a live person that day. That's a goal. That's why we have 15 people in investor relations. And so if we're taking smaller and smaller amounts, that would be impossible to do at that point. But thanks for your question, and hopefully we can partner at some point. So you answered the question about land costs, correct, Dave? Already?
About what costs? I'm sorry.
Expect higher land costs to impact projected.
Oh, no,
No.
I didn't, but I think, indirectly, but go ahead and fire away if you want.
Yeah, my opinion, just to answer your question, I don't think land costs will keep going up, first of all. So the assumption in your question, I would challenge. I think land costs are done going up. I think there's a better probability to go down than up. Now, that said, the land that we've purchased for our investments is deeply in the money. So if you're talking, maybe we're 30–40% of the money from what we paid in this fund. We don't mark up the land. You benefit from that work. But do I think it's going to keep going up? Not in the short run. I think in the short run, it'll either stay the same in value or go down 10%. I would challenge that assumption, period. Now, by the way, if it starts going up in value, that's really good for us because we already bought our land and we're not going to sell land that we bought. That's, we're developing. But what it really means, if land's going up, it's one or two things or a combination of two. It either means that rents are going up, which helps us, or the construction costs are going down, which helps us. So like those are the two variables that affect land the most. And, right now rent growth is quite strong, but the rate of rent increases has gone down, right? So it depends. I could say a statement, they're both true, and your mind will go to a different place. Rent growth is historically much stronger than it's ever been right now. And you'd say, wow, that's amazing. And then I could say, rent growth in the last month is remarkably less strong than it was in April or May. That's true too, right? It's still strong, but it was growing by 10%. Now it's growing by 4%. 4 is above the historical average. It's a great growth rate. But relative to 10, it's not, right? So like that's where we're at with rent growth. And then construction costs, same thing. I'll say two things that'll make you feel different. The increases in construction costs have gone from 15% annualized, and now it feels more like 3 or 4. And that's amazing. But I could also say, yeah, but we have 50% growth in costs and they're not going down yet. They're still going up, right? So it's growing off a higher base. So it really depends how you present and process information. What I will tell you is, broadly, it's still a really good asset class and investment to make with the right management team. And we believe we're that team. But in terms of, was it easier to make money in 2021 than 2022? Yes, it was. Like we were trying to shoot for 45% margins because 35 to 40 were just so easy to find. Now we're trying to shoot for 40 and we're still finding it, but it's hard. It's a lot of work. Would you agree, Dave? Like 2022, you work a lot harder to make the same amount of money.
No question. Yeah.
All right, so we're going to do 5 more minutes, but we can get through all this. Christopher, do you want to answer the question about preferred returns and catch-ups, or do you want me to do that?
I can take that quickly. So the question that Christopher had was, is the performance fee against income generated or something else? Please explain the 8% and 15 and catch up over that. So all returns, whether generated from income or sales, will go and so basically the way it works in priority is investors get their capital back. They get an 8% return on that capital compounded annually before we as the fund manager participate in the 15% promote. So that's the way it works. So we can walk through that in more detail, but just know that we're not getting paid $1 until you get your money back and an 8% compounding return on it. Then we share in 15% of the profits thereafter. The 50-50 catch up, it's pretty technical in terms of how it's structured, but so long as we're doing our job, ultimately we're generating a better than 8% return compounded annually on your investment. What that just means is that we're getting basically almost a true 15% share of profits. Basically, it has to do with the priority of return in which we get paid. So basically, you get your money back plus the 8, then we share in the profits of the next incremental. I have to do the math on it, Dave. I don't know if you know exactly what the percentage is in terms of what we share for the next distribution piece, but it just means that we get paid back a little bit and then we share the rest 85-15. So that's how it works. The catch up is actually a somewhat technical explanation, but I can't really do it in 4 seconds.
The way to think about it is, if we do our job, you're guaranteed your money back and 8% on your money before we get paid anything. In terms of the promote, like number one. So like an 8% return over 5 years, 4 years, it's pretty good return. And we've said, if you don't get all your money back and 8%, we won't get any incentive fee at all, any promote. But if we do, if you look at the totality of the fund, we will get 15% of the profits and you will get 10% of the profits. And that's how a catch up works, is we're caught up, but only after you make the 8%. So as an investor, you want to have the highest pref possible, because that means you're getting the money plus a return, all your money back plus a return. And an 8% preferred return is quite fair and good for you. It's friendly to the investor. And then the other thing I would tell you is, and I said this before, a 15% promote is on the very low end of the development fund. I would challenge you to find a development fund that has a promote that low, and with a manager this good, with this proven of a track record. I would say standard is 20. So in that category, you're saving 25% over what I believe market is. Okay, so Aaron asked a question about hedging. So we hedge 2 different ways, Aaron. Thanks for your question. One is called a swap. And so we'll do a swap. We typically borrow floating rate or variable interest rates from typically banks during construction. So those loans are priced above either SOFR, which used to be LIBOR, so that part of the curve, or some part of the fixed rate curve, but they're priced over. So think about when you're getting a loan, the loan is 250 basis points over SOFR, where SOFR right now is, around 250, 275, right? So your all-in rate would be in a 250 world, SOFR world would be 250 plus the spread. And so if you're borrowing variable, you're not hedged because you don't have fixed debt. And so what we do is a swap with the issuing bank, and we swap variable debt for fixed rate debt. And that locks in our rate for whatever period of time that swap is good for. And that's one way we hedge. Now, you can only use swaps if you have a loan, because the bank, the bank, if they're gonna do a swap with you, they require the loan as collateral for the swap. So you can't do a swap unless you have a loan. So what we're doing in addition to swaps is we're purchasing swaptions, which are options to exercise over a period of time into a swap contract. And the reason we do that is, for example, if we have a growth fund 4 deal that's in pre-development, but we know we're going to need to borrow 60 million against it in 8 months, because that's when we think we'll have pre-development done, and we'll have the equity and debt, and we'll start building. We'll do a swaption because we can't do a swap. We don't have a loan yet, but we do have interest rate exposure right now. And so that's when I mentioned earlier, we did the 700 million of hedging about a month ago now. I believe one was done 3.5 weeks ago and one was done 2.5 weeks ago. Those were swaptions, and those were to hedge future developments that don't have loans on them yet. We have done an entire webinar on hedging strategies. And so in our education section, you can find that webinar or email me and I can have our team send it to you. But as you can see, it's complicated, but it's also necessary. If you're a risk manager, you need to do it. Dave, I'm going to answer another question because it's relevant to what I covered. Thank you for your question, Michael. And I hope you're doing well, by the way, my friend. It's been a while. Shoot me a note. His question is, I'm an existing investor and I've already invested 47% in a fund 4. You mentioned that only 30% has been called. Why the discrepancy? And it's very simple. When that capital was called, the fund was smaller. When I say 30%, I'm making a presumption that we have a $200 million fund. When that was called, you were a much larger investor in a fund that's still raising and growing. You will not be called more capital than you committed. And so if you're at 47% and we wind up being a $200 million fund, your portion of future capital calls will be pro rata less because new capital is coming in and your interest in the fund is also going down. The fund is growing in size, but your percentage ownership is going down. The net is the same. And so all of this is equalized via our accounting department and our fund admin, but I can see where it would be confusing. I hope I've answered your question. And if not, email me, David at Origin Investments. And we'll handle that. And thanks for your question, Michael.
I'll take this question from Anonymous. The question is related to UBTI. And there was also a question write-in. Someone asked about K1 accounting, and they are interrelated. The fact that we structured this fund investment as an LLC as opposed to a REIT structure. Therefore, an LLC held within an IRA is subject to UBTI. So that's the reason for you receiving a K1. If this was a K1, I'm sorry, if this was a REIT, you receive a 1099 div and you wouldn't receive a K1. So it's really more an accounting issue. The question online was, can we get it in time for tax reporting? Absolutely. We make every effort to make sure that we're not holding up your personal tax filings. So the question was, how much UBTI will the fund generate? Difficult for me to tell or forecast, because we have projections on the overall returns for the fund, but we can certainly talk offline and give you some better estimates on that. But just know that there will be UBTI generated as a result of the fund being set up as an LLC structure.
Dave, that's it. We're an hour and 11 minutes in and 40 minutes into Q&A. I think we've done the best we can. There are a couple questions that we didn't get to, so I apologize. Just email me, David at Origin Investments. I want to be respectful of everyone's time. Thanks for joining us. I hope that we've conveyed the value of the fund and some of the strategy involved with it. If you have other questions, email us. Thanks for joining us, Dave. Have a good day, everyone.